All right. Well, welcome everybody again. Apologies for the Zoom link mix up here. Today is October 11th. We are, right at the beginning of the fourth quarter, and wow, what a year it's been. We've kept these meetings going proactively all throughout the year to try and keep you abreast of where we think we are in this market cycle. And it is pretty clear now that this is at least a bear market, and probably a bear market recession. I don't really care about the political definitions of a recession. I look at a recession as a slowdown in business spending, in business investment, and in business profitability. That's really all I care about. And there are some strong indications that when we look back on Q3, and certainly probably looking back on this quarter we're in right now, Q4, that we will see some drop in overall profitability for businesses. So my objective today is to help you understand where I think we are in this economic cycle, give you some strategies that we're looking at right now for clients. Some of them are strategies we've been doing all year round, but give you an idea of that, and then some thoughts and predictions about where I think a recovery will be. We're also lucky enough to have a little kind of a golden nugget here from Drew today, who's been doing some work on the new student loan forgiveness program and how that might affect maybe not you guys, but maybe people that you care about. And you can hopefully pass some of this golden nugget information along. So let's go ahead and get started. I'm gonna share my screen, and we'll go ahead and begin the presentation. All right, sorry, it just takes me a second to get this all set up. All right, great. So hopefully everybody can see the presentation now. All right. Okay, so we're actually going to start off with a little update on this student loan forgiveness program. So I'm going to hand it over to Drew now to talk about it. Go ahead, Drew.
Hi, everybody. Hope you guys are doing well. So some of you might have kids or grandkids with student loans, or have heard the headlines regarding student loans being forgiven. There's two things I think you should know about the plan. One being most federal student loan payments are currently still being paused until the end of this year. There's no signs of that being extended any further besides the end of 2022. The second one is, if anyone continued paying their student loans since the beginning of the pandemic, you should be able to get a refund of those payments made.
No.
The student loan forgiveness plan is only for federal loans, not private loans. Most borrowers will be eligible for forgiveness up to $10,000. It's $20,000 for Pell Grants, but that's a little bit more rare situation. The relief is limited to borrowers who make less than $125,000 a year, or $250,000 for the household. The borrower should be able to get back everything that was paid since March 13th of 2020. For example, my girlfriend had a small loan balance left, but she continued to pay off the loan throughout the pandemic just for peace of mind. Since her last payment was made in May of this year, she's eligible for a refund of all the payments she made since March of 2020. It's a slightly different process if the loan was paid in full during the pandemic. You'll have to request the payments back, though all the refunds should be automatic for borrowers who are eligible. But the education department will have an application available before the end of this year. Apparently, the easiest way to request a refund is to just contact the loan servicer. Just anything, phone number should be on your statement or through your online access. The deadline to submit an application for the loan forgiveness is all the way till the end of 2023, so there is some time here. I just did this. You can sign up for updates on ed.gov, and they'll send you emails with notifications once more information is available.
Awesome. Thanks, Drew. Appreciate that.
Of course.
All right. So if you would like any more information on loan forgiveness, or if anybody you care about has questions about loan forgiveness, please don't hesitate to connect them with us. We're happy to help. Not only our clients, but the people our clients love and care about. And we appreciate Drew, appreciate you keeping up to date on this. All right, so now let's talk about when the world is going on in the market and your portfolios. So we are at the phase in the cycle that I would describe as bouncing around the bottom. Okay. This is what we've seen in the market so far year to date. Okay, so what you can see here are all of the movements in the S&P 500 year to date, along with the timing of these Zoom calls that we've had. All right. Our first call we did in January 25th, when we first noticed the market start falling. We did that all the way through February and May. In July, we had a specific call about what to do with your cash. And I talked about different options for what I thought you should consider doing with any cash you had sitting in the bank right now. I introduced you all to the idea of the I bond, which many of you have taken advantage of, and I'm going to talk a little bit about again today. But I also encouraged you to take advantage of this low in the market. And if you had cash, get it invested, because we don't know when the recovery is going to happen. But when it does happen, there's an extra 20% return built into stock prices today that you will realize if you have the guts to buy low. Okay. Now, we had another call a little more than a month ago, August 31st, where I told all of you guys I thought we were heading to recovery. And then right after that, the market started dropping back down to our June, July lows. That was a tough pill to swallow, because I thought that was the bounce that was going to be moving upward. But the Fed has continued to be ultra aggressive fighting inflation, and that continues to make the market extremely nervous. It looks like they're very willing to push the economy into a recession if they have to, in order to fight inflation. And so that's kind of what we're facing right now is, as the market continues to test new bottoms, we're going to be keeping an eye really dead set on business profitability to see whether there are new lows in the market, or whether we're going to head towards recovery. But you have to remember, today's prices already factor in a high probability of lower corporate profits. If it's any better than that, the market will still go up, because the market does not reflect what is happening today. It reflects expectations of the future. And that's why we see in a typical recession, the market will bounce along the bottom. Okay, so speaking of typical recession, so this is a graphic of kind of a typical business cycle, right? You've got the expansionary period when real GDP is growing. Also, typically stocks are growing. Then you hit a peak, which represents the maximum output for the economy. But also, if this were a stock chart, this would be the point of maximum optimism. Okay. Then as GDP contracts, the stock market will drop before that happens. Okay. And the economy enters a recession. Okay. Now, the trough, okay, will be a period of time where the market is bouncing around, testing new lows in stock prices. Okay, some of that reflects, a conflict between optimism and pessimism at that point. Okay, but it's really the point of maximum fear in investors' minds, right? And there's even this thing called the fear index, right? And it's this point of kind of testing investors' maximum fear, maximum pessimism. Okay, and the trough of the market is truly a point where there is absolutely no good news to hang your hat on. This kind of idea that the night is darkest before the dawn, right? In stock market terms, it's very true, okay? Because the bottom of the market will be the point where, investors look around and there's simply no good news to be had. There's no expectation that things will get better. And that's a level of maximum pessimism, okay, that will push stock prices down as low as they will go, okay? And then things will only get better from there. Now, the stock market will recover before you start feeling better, okay? That's just a simple fact, okay? Before the individual investor begins feeling better, begins feeling optimistic, the market will start going up. And so what we're going to see throughout Q4 is the market bouncing around what I think is the trough. Okay, it's going to go up a little bit, it's going to go down a little bit, up a little bit, down a little bit. We might test some new lows, okay? But one of these peaks that we have will be the last peak. That peak will be the beginning of the recovery. And then the market will increase very quickly, quicker than you can react and get into it, right? Because, just like I thought back in August that this peak here was the beginning of the recovery, and it wasn't, okay? The next peak may very well be, or it won't be. There's simply no way to know, which is why buying low and not trying to test the very, very, very bottom is about as good as you can get, okay? All right, so where are we at in the cycle? Again, we might be at the bottom, we might not quite be at the bottom, but looking back at some averages is instructive at helping us understand, okay? So when what this chart shows you is based on the declines in the market, how long did that drop last, okay? So when the market has dropped 20% or more, which is where we're at today, okay? First off, that happens about once every 6 years. So, here we go, right? Now, the average length from top to bottom, okay, so from peak to trough, the average length was a little bit more than a year, 401 days. Now, that's the average, okay? We stand today at about 300-ish days into it, okay? So, maybe we're there, maybe we're not, maybe we're going to bounce around for another 100 days. There's no way to know. That's why we call it an average, right? But on average, it takes a little more than a year to go from peak to trough. All right. And, the last time, of course, we saw this was in the COVID crash. Okay. Last time we saw all of this was in the COVID crash. Okay. But it's important to kind of keep that idea. So peak to trough average about a year, a little more than a year. Okay. Now, this chart shows you the average for full recovery. So peak to trough to brand new high, brand new all-time high, right? Peak, trough, brand new all-time high, all right? Now, what this shows is that on average, it's anywhere from 16 to 24 months, okay, from peak to trough to new all-time high. So if it's 16 months, we're a little more than halfway through to a new all-time high. If it's something more like a 24-month full recovery period, then we're not quite halfway through. But either way, all indications are we are somewhere around that trough, okay? And again, that's why I say a reasonable expectation is the fourth quarter is going to be a lot of bouncing around the bottom, all right? Okay, let me just give you a quick heads up about what returns you're going to see in your quarterly reports that are going to be on their way right now. Okay, we just closed out the third quarter. Okay, and guess what? It looks very similar to when we closed out the second quarter. We basically ended up at the same point we were at the end of June 30th is where we ended September 30th. All right. So most of my clients are in one of these three portfolio styles. Now, your individual performance may vary some from these numbers. These are averages across all of our clients. Okay. So depending on when your money came in, when your money went out, your individual returns will be different than this. But I just wanted to give you a heads up, an idea about what you should expect to see when your performance report comes. All right. So if you are still 5 or more years away from retirement, you are probably in one of my growth portfolios. Okay. And your returns year to date are down about 22%. Okay. Over the last 12 months total, 1 year total, pretty similar, down about 19%. So far, quarter to date, which is kind of silly, that's just so far in October. But so far in October, you're up about 0.5%. So yay, let's celebrate something. Okay. Now, the truth is the other portfolios aren't that much different from my growth portfolio. They're only slightly better returns because they're more conservative, but because bonds have very disappointingly been not very good performance this year, the performance across all these portfolios is down. Okay. So if you're in early retirement or very close to retirement, you're probably in my growth and income portfolio, which is currently down about 21% year to date. Okay. And then if you're in later retirement or in a more conservative portfolio model, that's what we call our income model, down about 20% year to date. Okay. So all down, and they're all down very similar to what they were at the end of Q3. So if like me, you were really optimistic about a bounce in Q3, it didn't happen. Okay. You pretty much stayed exactly where you were from the end of Q2 to the end of Q3. Okay, want to give you guys a summary of kind of what we've been doing for you inside your portfolio year to date. Okay, we started off back in December of 2021. Okay, before this bear market recession began, and we started by protecting some of the bonds in your portfolio using structured notes. All right, one of those structured notes recently turned into cash, and we use that as an opportunity to buy into stocks. Also, all throughout this year in your non-retirement accounts, we've been doing tax loss harvesting. Okay, we did it in March, we did it in May, we did it in July, and then we just did it again last week. All right, tax loss harvesting is kind of the one silver lining we can put on a drop like this, and it's a way of creating tax losses that you can use to dramatically lower your tax bill in the coming years. All right, it'll be these tax losses can be used to offset capital gains either generated this year or generated in future years. All right, so it's just an excellent kind of value added strategy that we can do. Back in June and July, I recommended strongly that anybody who had cash get it into the market. And guess what? I'm doing that again today. All right. Strongly recommending that. All right. Last month in September, we completed the buyback of stocks using any cash that came in from the Barclays structured note being called. And then in the last week of September, we made, for us, a pretty dramatic move to sell about 10% of the portfolio from bonds and shift it into stocks. We are now, across the board for all of our clients, we are at the maximum stock allocation that we can go. So we are aggressively buying into this down market so that when the recovery happens, okay, which it will happen, it's just a matter of time. When that recovery happens, your portfolio will appreciate the greatest amount it can, okay, so that we get to that recovery point as quickly as possible. I want your portfolios back to new all-time highs as quick as possible. And this is the strategy to get there. Okay, so what to do with cash right now? This is a regurgitation of my recommendations back in June and July of this year. Okay, First, I want you to look at your cash right now, okay, and think about, okay, what of my cash should I be putting in savings, money markets, and CDs? Right now, those are paying about 2%, and you could probably actually find somewhere around 2.5% at some of the online banks, all right? Not bad. I mean, certainly compared to what we've become used to in savings accounts, getting 2.5% FDIC insured is a great idea. If you are wanting to put more than $250,000 in FDIC insured accounts right now, reach out to us. We can help you structure it to get more than $250,000 of FDIC insurance, FDIC insured protection. Okay. I also introduced you to the Series I bond, which many of you told me you took advantage of. I think it's a great deal. It's a variable rate bond, US bond, paying 8 to 9% right now. I actually think it's over 9% now. And as long as you can hold the bond for at least 12 months, and ideally something like 5 years, it's a no-brainer, frankly. Okay. The only downside is you can only put up to about $15,000 a year into it. All right. But I know many of you took advantage of it, and I think it's a great idea. But still, your best upside is investing in your portfolio here with Village Wealth. And that's what I strongly encourage you guys to do. So now when you're looking at your cash, right, you need to divide your cash up amongst emergency fund, short-term goals, and long-term savings. Okay. The money that you need for your emergency fund, you should be putting in savings, money market, CDs, FDIC insurance, right? And you want somewhere between 6 to no more than 12 months of spending money in that emergency fund. Anything more than that is just is excessive, and you're really losing money having that dead money sitting there in FDIC insurance. Now, for your short-term goals, the Series I bond is a great option for funding some of those short-term goals, right? Things, goals that are a year out, 2 years out, really no more than 3 years out. I would seriously be looking at the Series I bond. I don't have a lot of great other options for you, but treasuries are starting to pay, a decent amount. So you can even get a 2 or 3 year treasury bond that'll pay in the 3s. So again, I can help you with some of those goal setting. But really, all of your long-term savings beyond what you need for emergency fund and short-term goals, it's time to get that money working. It's time to buy low, which isn't easy, but it's time to buy low so that you can get those good returns and sell high in the future. Okay, so thoughts and predictions. What do I think is coming up here? Okay, I am expecting a market recovery now by about the end of Q2 2023. So about the end of June of 2023 is where I think we will be when the market recovers. Now, I keep pushing that date back. Okay, at the beginning of this, back in February and March, I was saying I really thought we would finish this calendar year with a slightly positive return. That would be extremely optimistic at this point. We would have to see a 20% recovery, between now and the end of December. And I would love to say I think that's realistic, but I just don't think that's realistic. I think it's much more likely that we spend the fourth quarter bouncing around the bottom, and then the recovery begins happening in Q1 and Q2 next year. Okay. The Fed is almost certainly going to raise interest rates one more time by 75 bips. I don't think they're going to raise it more than 1.5% from where it is today before they will be done. I think after this 75-point increase, they're going to slow things down a little bit, because I think they're going to start seeing economic indications this quarter that not only is inflation coming down, but demand is coming down, and the gap in wages, well, the gap in between the number of job openings versus the number of candidates is going to start to close. Okay, so it's going to close the wage gap, it's going to close the supply demand gap. prices are going to slow down, and the Fed will not have to continue aggressively raising interest rates. Let's really hope that that is the case, because if they do have to continue raising interest rates aggressively beyond that, it's really going to slow down the potential growth of our economy. Interest rates in the mid-single digits are very, very healthy for an economy. That's a good thing. We want that. That's where we want to settle. We do not want interest rates in the high single digits, low double digits. That is not healthy for an economy. Okay. Oh, and in case you think that this is a uniquely US problem, not at all. Okay. Inflation is a problem in every single one of the G7 countries right now. And the entire world is literally doing pretty much exactly what the Fed is doing right now, dramatically raising interest rates, trying to suck the cash out, trying to bring the interest rates down. The whole world kind of followed suit when our Fed decided to just flood the market with lots and lots of cash. And the whole world kind of followed suit when we delayed too long in sucking it back out. And so we're all kind of in the same boat together. But there are indications across the entire world that inflation is starting to slow down. A lot of the G7 countries are starting to report that their own interest rate increases are starting to take effect, and inflation is slowing. So again, Q4, I predict that we'll end up bouncing around the bottom, but I do think it's going to be a positive quarter. I think we're going to have about a 5% increase in portfolio values this quarter alone. Now, of course, that's not going to get us back to recovery, okay, but it will be a nice bump up from where we are. I don't see us finishing the quarter lower than we are today. All right. That's the end of our prepared remarks. Other than the excitement about a new baby coming, I did want to tell you all and thank you all. On Friday, we found out that Village Wealth Advisors has been named the best financial planning firm in Ventura County by the Ventura County Star. So many of you guys voted for us in that, and I so appreciate your support. And we managed to beat out Fidelity, Edward Jones, Chase Bank, and another relatively smaller firm like us. So thank you for all your votes. It was very cool to be named best financial planning firm in Ventura County. I'm extremely proud of our team because we're all working together very well through. This has been a tough year. This has not been fun, but this is when frankly, what we do is most valuable to all of you, because when the market's just going up, making money is easy. It's when the market goes down that our emotions get very high, and you guys all have the benefit of a team that can take the emotion out of it and really keep to the discipline of buy low, sell high, keep you invested, and get your long-term returns up to where you need them to be. So that's what we're going to keep trying to do. All right, I will go ahead and open it up to any questions that anybody has.
Yeah, John.
Hey, Steve.
Okay. Yeah, I got a couple of questions here. So I don't see inflation going lower like you seem to see it. I see gasoline prices going up, and my wife goes shopping at the market, and she comes back depressed because she sees all the prices going up.
Yeah.
So I don't see where you get that inflation isn't going to be a factor in it, right? And the Fed is still going to press on interest rates going up if inflation isn't going down. And so you're going out on a limb here saying what you're saying. And one other thing before I give it back to you, and that is the Barclays, right? They closed down the structured notes, so we have all that cash. And what I was hoping is that since I get distributions and it's kind of hard to sell stocks at this point to get those distributions, why don't we use that money for the distributions instead of buying stocks. Because
Yeah.
you're selling stocks in order to pay out a distribution along with taxes. So why not just leave that cash, which we got at a, it's a chunk of money that isn't being sold at the bottom, right? Because it was bought into the structured note. So why would you consider that using that as cash instead of buying stocks?
Yeah, no, great question. Okay, so let me share with you, why I go out on a limb and say that inflation is going down. All right, so this is a chart real quick of global commodities prices, okay, across the world right here, and each of these charts represents a different measure of a global commodity. Okay, so in darker green you've got energy commodities. In gray here, you've got industrial metals, precious metals, and then agricultural products and livestock. Okay, and so what we've seen right here is we got a peak in prices of all of these commodities. Okay, in the second quarter. All right, and then throughout the third quarter, literally every single one of these prices have dropped. Okay, now it's not like it's back to all-time lows or anything, okay, but all commodities prices globally have been dropping. Okay, and so this is a really important measure because energy is you can kind of toss out energy. Energy is largely controlled by the suppliers manipulating the supply of oil, right? But these other commodities are generally traded, right? And are free markets, okay? And the fact that all of those prices are coming down is a really good indication that globally inflation is starting to slow down. And so, yes, I recognize that you are not feeling it, okay? But what we feel individually as participants in the market is not the best indication of what the Fed is likely to do in response to inflation. This is the data the Fed is looking at when they're making their policy decisions. And this is one of the data points that they need to see starting to drop for them to be comfortable slowing down the interest rate increases. Does that make sense?
Yeah, but having said that, the Fed just raised interest rates not even 2 weeks ago or however long ago. And I'm sure that they looked at those charts and they still ignored them and they went ahead and raised it. The whole point.
Well, they didn't ignore them. What the chart shows is that what they're doing is working. Okay, they're looking at that and they're going, good. Okay, these rising interest rates are slowing down inflation. They are bringing down commodities prices. Now, they're not done, right? It's not down enough for them to be happy, okay? But it is down, okay? Which is why I think with another, interest rate increase or two, we should, we should be done. I really hope they're going to be done. But we'll see. This is playing the odds at this point, right? We don't know. We're trying to guess at what the policymakers are likely to do and what that's likely to do to the economy. But yeah, inflation is slowing, and that's a good thing, no matter what side of the equation you're on. Oh, and then the second part of your question, the Barclays note. Okay, so for all of our clients who are doing distributions from your portfolio, okay, keeping an appropriate amount of cash in the portfolio to fund those distributions is a constant moving target for us. Okay, we're always fluctuating between about 1 and 6 months or so worth of cash built up in the portfolio. So I can't disagree with you. The most conservative, the safest thing we could have done would be to just leave that money in cash, okay? But the strategy that will likely benefit you the most was to get that cash invested beyond what we needed to fund, 1 to 6 months worth of distributions, okay? Keeping 1 to 6 months of distributions is just smart portfolio management, okay? But keeping cash beyond that is just dead cash, right? It's just dead money, right? the smartest thing, the most the decision that was devoid of emotion, the most practical decision was to get that money invested and get it growing for you, where the greatest return was likely to be received, which is back in stocks. It's like, you ask anybody off the street and you go, hey, what's the key to successful investing? And they go, buy low, sell high. And a year ago, if I would have asked you, hey, if the market dropped 20% and you had cash, what should you do with it? You'd go, buy low. But when you're in the middle of it, and that opportunity is actually in front of you, it's the hardest thing in the world to do, which is why you hire us to do it for you, because we can do it without that fear. So that
you see no recession then in Q1 or Q2. You see no. Most of the people on television or you listen to, a lot of them say it's going to be a recession in Q1 or Q2, but you're not in that camp.
You're talking Q1, Q2, 2023.
Yeah,
it might, maybe, but I'm not. So here's the thing. The probability of a recession in Q1 and Q2 is already built into today's stock prices. Okay, let's say there's a 50-50 chance. Okay, that probability is already built into today's stock prices. Okay, so if when the probability of that recession goes up, which at some point it'll reach 100%, but it won't be until way after that. Okay, that new information will be built into stock prices, right? So there is a possibility, absolutely, that we go into a recession and that could test new market lows, okay? But I'm not trying to time the bottom of the market. I'm trying to look 12 to 24 months from now and go, okay, that's where I need to get your portfolios. All right, so the quicker I can get them back to full recovery, the better job we've done. I know I'm not perfectly answering your question, Steve, but
that's fine.
But I hope that gives you an idea where my head is.
Okay, thank you, John.
Sure. Any other questions? All right, great. Well, thank you everybody for being here. We'll blast out the recording of this video for you. If you know any friends or family that would benefit from any of this information, you can forward the video recording to them. If you do have any specific questions that you want to go over, please reach out. I'm happy to schedule a quick 20-minute call to go over it. Yeah, and that's it. Thank you. So yeah, Steve.
Can I have a question for Drew? Okay, so Drew, what if you recently paid off those loans, those student loans? Will you get that money back that you paid?
Yes, everything paid since March 13th of 2020 is eligible for refund.
Everything, even the whole loan?
Up to $10,000.
Oh,
Yes. Up to $10,000.
okay.
And subject to the income limitations.
Yes.
That's right. Oh, okay. Thank you.
Yep. All right, everybody. Thank you so much. Have a great day. Appreciate you being on. Take care.
Thank you, John.
Thank you.